Welcome to Investors Insight. Today we're analyzing Advanced Micro Devices, AMD, trading on NASDAQ under the ticker symbol AMD. AMD is a fabless semiconductor company that designs high-performance CPUs and GPUs for data centers, PCs, gaming, and embedded systems. Once dismissed as a distant second to Intel and NVIDIA, AMD has undergone a remarkable transformation under CEO Lisa Su, evolving into a genuine AI infrastructure contender. Let's put AMD through our 10-point evaluation framework and find out whether this challenger deserves a place in your portfolio. Before we dive into the details, here is the big picture. AMD's investment case rests on three pillars. Pillar 1, the engine. AMD is positioning itself to capture a share of a $1 trillion AI chip market by 2030, driving aggressive earnings per share expansion. Pillar 2, the drivers. CEO Lisa Su's proven execution record is backed by a pristine balance sheet carrying over $8.5 billion in net cash, while free cash flow is growing at an exceptional pace. Pillar 3, the brakes. The stock is priced for perfection at 97 times forward earnings, and the company faces severe sensitivity to China export restrictions and NVIDIA's deeply entrenched CUDA ecosystem. Keep those three pillars in mind as we work through all 10 categories. Item 1. Business model. Scored 7 out of 10. AMD generates revenue across three main segments. Data center, which includes EPYC server CPUs and Instinct AI GPUs, reached $16.6 billion in 2025, up 32% year-over-year. The client and gaming segment surged 51% to $14.6 billion. Embedded, tied to FPGAs from the Xilinx acquisition, dipped slightly to $3.5 billion. Total 2025 revenue hit a record $34.6 billion, a 34% annual increase. The key structural shift here is that AMD is no longer a cyclical consumer chip maker. It is rapidly transitioning into a foundational hyperscaler infrastructure provider. The total AI chip market is projected to grow from $107 billion in 2026 to nearly $600 billion by 2033. Item 2. Financial status. Scored 7 out of 10. AMD's balance sheet is genuinely strong. Cash and short-term investments stand at $12.35 billion versus debt of just $3.87 billion, giving a net cash position of approximately $8.5 billion and a debt-to-equity ratio of only 0.06. Free cash flow has been on a remarkable trajectory, $1.1 billion in 2023, doubling to $2.4 billion in 2024 and exploding to $8.6 billion on a trailing 12-month basis into 2026. Revenue CAGR from 2020 through 2025 sits at an exceptional 29%. One important caution: return on equity of 8.1% and ROIC of 7.8% look suppressed, but that is largely an artifact of the massive intangible assets recorded from the 2022 Xilinx acquisition, not underlying weakness. Item 3. Growth potential. Scored 8 out of 10, one of AMD's strongest categories. The EPS roadmap is ambitious. Consensus expects $4.99 in 2026, up 20%. Bernstein projects a jump to $14.60 by 2027, implying 193% growth. AMD's own long-term target is earnings per share above $20 by around 2028. Three catalysts drive this. First, hardware execution. The MI350 GPU series entered mass production in late 2025, and Helios rack-scale AI systems are coming in late 2026. Second, aggressive R&D. AMD sustains spending above 20% of revenue with heavy investment in ROCm 7.0 software and silicon photonics. Third, strategic M&A. The ZT Systems acquisition secures full rack-scale AI infrastructure capability and AI talent. Item 4, Competitive Advantage and Moat, scored 7 out of 10. In server CPUs, AMD's EPYC processors now hold more than 40% market share, a remarkable reversal from near zero a decade ago, while Intel has fallen below 60% and is still declining. In GPU hardware, AMD's MI300X carries 192 gigabytes of HBM memory versus NVIDIA's H100 at 80 gigabytes, a clear hardware advantage. AMD also holds a massive IP and FPGA portfolio inherited from Xilinx. However, the single largest structural barrier remains GPU software. NVIDIA's CUDA ecosystem has a 20-year head start and more than 4 million developers. AMD's ROCm is improving rapidly, but CUDA's switching costs mean NVIDIA commands 80 to 87% of the AI GPU market, while AMD holds only 5 to 8%. Item 5. Management and Governance, scored 8 out of 10. The Lisa Su story is extraordinary. When she became CEO in 2014, AMD's market capitalization was roughly $3 billion. By 2026, it has surpassed $200 billion, a roughly 67-fold increase. She led the Zen architecture pivot that reclaimed server market share from Intel, executed the Xilinx acquisition seamlessly, and was named Time's CEO of the Year in 2024. On the financial side, CFO Jean Hu has struck the right balance between aggressive R&D reinvestment and debt reduction. Executive compensation is tied to performance stock units that delivered more than 50 percentage points of outperformance versus the S&P 500. Governance risk is limited. There are no significant scandals or accounting concerns on record. Item 6. Valuation, scored 5 out of 10. And this is where we must be honest about the risks. At a current price of approximately $345, AMD trades at 97 times forward earnings and 113 times EV/EBITDA. For context, NVIDIA, the market leader, trades at roughly 21 times its FY 2027 earnings estimate, making AMD significantly more expensive than its direct competitor. The stock has risen over 300% in the past year, pricing in the hypergrowth narrative in full. The saving grace is the PEG ratio of approximately 1.18, which reflects AMD's projected EPS CAGR of 82% from 2025 to 2028. But that math only works if AMD executes flawlessly. Any earnings miss, any guidance cut, any geopolitical disruption, and this valuation has no cushion. Item 7. Macro and Industry Environment, scored 7 out of 10. The tailwinds are powerful. Goldman Sachs estimates that global AI infrastructure spending will cross $750 billion in 2026 alone, and AI-enabled PC refresh cycles are accelerating demand for Ryzen AI processors. On the headwind side, persistently elevated interest rates continue to compress valuation multiples for high-growth names. The emergence of custom silicon from Google, Amazon, and others could erode AMD's addressable market over time. But the critical friction point, the one that can move AMD's stock 10 to 15% in a single day, is U.S. export restrictions. The BIS ban on MI308 chips sold to China caused an $800 million inventory write-down in Q2 2025. This geopolitical variable is unpredictable and impossible to fully model. Item 8. Risk factors, scored 6 out of 10. 4 key risks warrant close attention. Node 1, highest priority, is NVIDIA's accelerating product cadence. The rapid progression from Hopper to Blackwell to Vera Rubin threatens to widen the performance gap before AMD's MI400 series can respond. Node 2 is hyperscaler concentration. Microsoft, Meta, Amazon, and Google collectively represent the majority of AMD's data center revenue, creating dangerous single-customer dependency. Node 3 is China export bans, a proven vulnerability that already cost $800 million in one quarter. Node 4 is Taiwan geopolitics. Despite TSMC's new Arizona fabs, the majority of AMD's advanced chip production remains concentrated in Taiwan, representing a severe supply chain bottleneck in a worst-case scenario. Item 9. Shareholder Return Policy, scored 5 out of 10. AMD pays no dividend and none is expected for the foreseeable future. Management has explicitly chosen to prioritize aggressive AI reinvestment over shareholder income distributions. On buybacks, AMD repurchased $862 million worth of shares, about 5.9 million shares, in 2024. However, heavy stock-based compensation largely offsets the dilution-reducing effect, so net share count reduction has been modest. The ultimate return mechanism for AMD shareholders is pure capital appreciation. Over the past decade, AMD stock has returned approximately 70 times for long-term holders. If you are an income investor seeking dividends or yield, AMD is simply not the right vehicle. This is a capital gains story, start to finish. Item 10. Judgment by investment style, scored 7 out of 10. For growth investors, AMD scores 4 out of 5, a high fit. Accelerating revenue expected to grow 40% in 2026, expanding EPYC server share, and massive AI GPU upside make AMD compelling for investors who are comfortable tolerating low gap margins in exchange for long-term TAM capture. For value investors, the score drops to 2 out of 5, a low fit. A 97 times PE ratio is simply incompatible with traditional intrinsic value frameworks. There is no margin of safety here. For income investors, the score is 1 out of 5. Avoid entirely. With zero dividend yield and a return structure fully dependent on capital gains and multiple expansion, AMD offers nothing for income-oriented portfolios. AMD's final score is 67 out of 100, but as the synthesis insight on this slide makes clear, 67 is not a mediocre grade. It is the exact geometric profile of a premium-priced, hyper-growth challenger. The strengths are concentrated in management at 8, growth potential at 8, and financial health at 7, all reflecting AMD's genuine competitive momentum and exceptional execution. The drags come from two specific categories: valuation at just 5 and shareholder returns at just 5. These are not weaknesses in the business. They are the price you pay for owning a company priced for a perfect future. AMD is a high-conviction, high-risk, high-reward asset for investors with a long time horizon and the stomach for volatility. Final verdict. AMD is the definitive number 2 AI infrastructure play. If ROCM captures even a fraction of NVIDIA's monopoly over the software ecosystem, the 2030 upside is immense. EPYC CPU dominance and Instinct GPU expansion together provide a credible pathway toward the $1 trillion total addressable market target. But at 97 times earnings, the margin for error is exactly 0. This is a high-conviction asset strictly for long-term growth investors who are prepared to absorb geopolitical volatility and premium multiples. That's our 10-point analysis of AMD. What do you think? Are you bullish on AMD's challenge to NVIDIA? Or is the valuation a deal-breaker? Leave your thoughts in the comments. If you found this analysis valuable, please like and subscribe. We'll see you in the next episode.